I think we've come out of the worst of it, to be honest, in terms of the initial onset and the fears that started to emerge about a potential spate of runs on the banks, akin to what we saw at SVB originally and then Signature. That initial panic, I think, has subsided, and I think also rightly so, because the emergency measures put in place by the Fed and then subsequently by other central banks do, I think, address the issues not that led to the problems at those banks, but that precipitated the runs on the banks. So things like the Fed's move to allow banks to borrow from the Fed against the book value of their loan portfolio. So avoiding that write down to long-term bonds is something that should protect other banks. So these measures are really extraordinary. And in theory, I caution that, in theory, should keep tensions calm. But of course, confidence is always a major issue. Confidence is notoriously unpredictable, and of course it's impossible to know exactly how people are going to feel from one day to the next. It can move fast. So in theory, we should be in a better place now, but we'll have to make sure market confidence stays up.
When it comes to the risks on the horizon, do you think that the risks, the potential hotspots are known to the market, known to the Fed at this stage? Or if there is going to be something to derail the economy moving forward, is it going to be something like a black swan event?
It probably will be a black swan, because we've never really had a crisis that was, forecast well in advance and something that is a known quantity. So the idea that we saw in the case of the two failed U.S. banks, some loan issues where they kind of had that balance sheet management that wasn't really what it should have been, and that was known to regulators, but it's never kind of apparent that it's going to be the switch that flips and it sends us off. So of course we're all looking now for the other areas that could be troublesome, looking not just at banks, but non-bank lenders, which for the U.S. in particular are a significant part of lending. To see where that might arise. But again, the fact that we have that emergency liquidity from the Fed, that kind of cushion for the economy that we got during the pandemic, and we're getting it again now, should help to avoid some of the problems we've seen so far.
When it comes to the inflation outlook, there are a number of people who take the view that inflation is now going to be structurally higher moving forward for a number of reasons. The demise of globalization and what we're seeing in terms of reshoring and investment, defense spending on the up. Do you think there's any chance that we see the Fed reassess its inflation target and adjust up its inflation target from 2 to something like 3%?
I think that's a really interesting question. We've seen a lot of talk about 3%. I think it is a realistic possibility. But we have to remember that the Fed, just prior to the pandemic, had shifted its thinking already. Instead of thinking about annual inflation targets, they started talking about long-term inflation targets. And they didn't even put a time period on that over the long-term phrase. So already, because inflation had undershot 2% for the better part of a decade, I think the Fed was already, in an ideal world, hoping to see inflation overshoot 2%, probably for the same period of time, in order to get to that long-term stability. Now, we are currently in that situation where we're likely to see inflation above or close to 2% for quite some time, for all the reasons that you mentioned, changes to supply chains and pressure in the labor market, et cetera. So we probably will, but I don't know if we look to the really, really long term, say past 2030, if we'll be in a different situation. I think probably there will be pressures bringing inflation back down afterwards. But in the next 5 to potentially 10 years, probably we're looking at higher inflation, yeah.